Welcome, everybody. My name is Chris Vermeulen from thetechnicaltraders.com, and I'm here to give you this quarterly report on precious metals for strategic wealth preservation. Now, let's dive right into the charts here and take a look at what we see. Now, if we take a look at the chart of gold, now this is the daily chart of gold with the blue line, which is the 50-day moving average, and the 200-day moving average below, which is the green and red. And typically when the 200-day moving average is sloping down and when the 50-day moving average is below that one, we tend to find the market to be in a bearish stage. And we can see that back over here in late 2018. We saw the gold under both those moving averages. And then finally, we started to see gold firm up. And then in 2019, we saw gold start a new multi-year bull market. Now, where we are now is within this giant, I think, super cycle to the upside, this commodity super cycle. We are seeing this large bull flag pattern, which is a strong pattern long term. When we look at it on a daily chart like we are now, though, we are in somewhat of a bear market phase where it's just out of favor. Price is below the 200-day. The 50-day is also below that. And so that's a point where the market is digesting the recent rally. We did see gold rally from roughly 1,200 all the way up to almost 2,100. And so now it's taking a breather. And this is a perfectly normal consolidation phase. In fact, it's called a bull flag pattern. And we've seen this happen over and over again. And the markets are fractals. So these patterns can happen on any time frame and they can be in any size they are. Now, if we look back here, we had the first bull flag pattern. We had the second bull flag pattern. We had the COVID kind of blip in here. And now we've rallied up. And we are really, if you look at this entire pattern as one large bull flag pull, we are now in this giant bull flag where it is consolidating, just like we saw over here and just like over here. This pattern is pointing to a dramatically higher pricing over the next 6 to 12 months. But at this point, it is out of favor and it's just the market digesting. This is when people are accumulating. It's also when obviously people are selling their positions because they get bored of gold not moving, or any asset class for that matter. When it's trading sideways, it's just changing hands, contracts from people who are worried, sell them into positions or investors who want to hold gold longer term. And this is just a platform. Eventually this will end and we should see the initial trend continue, which the initial trend was up. And this is just a pause, and then we're going to go higher. Now, if we were to take another look at gold and zoom in a little bit more here, we've had some interesting price action happen really this year. If we look back over in March, when we put in this low, we came back down for a double bottom. And it's something I was expecting. We're probably going to see this sell-off was so sharp that we saw back in August. I expected we'd probably come back down for some type of double dip. And that is what we have seen now. You can see we had this little cluster of 3 bars kind of overlapping here. And more or less, we have come back into this area. Now, the big question is, are we going to go for a full double dip down to this low over here? At this point, this kind of looks like the double dip has somewhat been made. But what's interesting is we've had 17 or 18 days to the upside. We've had 17 to 18 days to the downside. And what we saw back in March when we had this double dip here, it was 8 days up, 8 days down. And the markets are very balanced in terms of these patterns. The grand scheme of things, though, gold is trending lower. It's making a series of lower highs. It's struggling here to try to hold support around 1700 area. And we just really need to see what's going to happen. From an investor standpoint, obviously, this is a quarterly report for investors. This is, let's actually take a look at the quarterly chart of gold. Now, the data doesn't go back all that far. Let me just clear some drawings. What you can see here, we are in a strong rally. We just had a multi-year consolidation of base. It's broken out to new highs, and now it's pulling back. And so it's actually a very similar pattern to what we kind of saw over here initially. We saw this huge run up and this great big spike in price. And then it went out of favor for a very long time. And that's what commodities tend to do. Eventually, you're going to start another run up. You're going to break a previous high, which is this high over here. And then you're going to have some type of pullback, some type of little kind of bull flag pullback. And then it's going to go up and take a run for that second half of that move. Using Fibonacci, we can measure these moves. And that's where we are right now. We just had a multi-year consolidation. Gold just put in its first big rally. It just broke this previous high over here in the last year and a half. And now it's having that pullback phase, settling down into support. It broke out. It's coming down to kiss it goodbye. Hopefully, we're going to see that rally a whole lot higher. So that's where we stand in the grand scheme of things. Remember, each bar here is a quarter. This goes back to the 1980s. So these are big cycles and big patterns that take a long time to play out. But the odds are this market will eventually resolve to the upside, and 2,600 is the next measured move for gold going forward. It could go a lot further than that, but that is the next measured move based on technical analysis. Now, if we take a look over at silver to get a feel for that, this is the quarterly chart for silver, and silver's got a little bit more of a disconnect. We have not broken to new highs. It really put in a multi-year kind of base, kind of popped and broke out, and it's settling back down. Not as clear of a chart as gold, and that's because this is more of a speculative asset class. It's not held worldwide by as many investors. It's not seen as like a safe haven type of play. Silver is a lot more speculative. So it hasn't really accumulated. We've had a lot of fear in the world in the last few years, which is why gold has gone up and it's holding its value and hit new highs. Where silver is people who have extra money, they want to throw it into something risky to hopefully make some bigger returns. So it just doesn't quite see the same. Percentage-wise, when precious metals run, silver typically moves percentage-wise a whole lot more than gold, but gold is that global defensive play where people are naturally accumulating and holding it long-term, and that's why gold has been making higher highs and holding its value fairly well. Now let's go take a look. Let's take a look at the shorter-term chart of silver. Let's go to the daily chart real quick. And silver has broken a pretty critical level. It pierced it in the last week. If we were to draw a line across these wick lows over here, roughly around this 22 level, we've come down, we've kind of tagged it intraday late last year. We came back down and we actually pierced and closed below it for one trading session last week, which was the first week of October. And then we saw it pop back up. And now we're holding back above that level. But overall, this is a pretty strong line in the sand for silver. If it closes below there on a weekly basis, we could see quite a bit lower silver pricing. And we can use Fibonacci extension, which measures momentum of these previous moves. I'm going to go from this high down to this fairly significant spike low and this larger bear flag pattern. And that, to me, a bear flag is a halfway point. So if we were to just look at this chart pattern, what are all these lines saying? Well, if we connect the dots here, we've got this first sell-off. You've got this bear flag rebound, which is known as the halfway point. And then you've got the 100% measured move, which is what the 1 stands for right down here. That is the downside potential move around 1830, 19, somewhere in this range. It's going to try to find a critical support zone based on this pattern. And so you've got the first half of the sell-off, you got the bounce, you have the second half of that sell-off. So I'm not saying that is going to happen, but that is a possibility, and that's where it's going to find support. Roughly, really, yeah, between $18 and $19 an ounce if it gets down there and going forward. And that would probably be gold going back down to test that $16.90, $16.70 level that we saw back in August when price spiked and sold off. And that could be another double dip for gold going forward. Let's take a quick look over at platinum and palladium. A little messy chart on here. Let me clean that up. More or less, we're looking at the daily chart. It's clearly in a downtrend. We got the 200-day moving average moving lower, which is why it's red. The 50-day is also below it, and price is below the 50-day. Now, if we were to zoom out on this chart a little bit, platinum is trying to find support in this area. There's a lot of volume traded through this area. If we were to just kind of box in this area that it is in right here, whoops, hold on, sorry about that. This is the more some price trades in an area, the more support or resistance there will be depending on which way you're coming down to that level. Now, we've seen a price trade a lot through this area. It's acted as major support levels, acted as resistance areas, traded through it a lot. And then now we're coming back down. We've tagged that and bounced back up. Overall, this level really needs to hold. Platinum is trying to break. It had a nice run. It broke into a bull market. It's pulled back pretty deep. If we take a look at it from a quarterly chart standpoint and just stretch it out a little bit, you can see here, it looks like it's put in what looks to be a bottoming pattern, a big washout low. It's had a nice impulse wave. So it's broken this high, and now it's pulling back and testing into support. A lot like what gold is doing right now. I think there's potential for this to start to rally up and move higher. But again, we're going to need the US dollar to roll over and sell off. And we need overall metal flow, money to start flowing into these commodities here. Taking a look at Palladium, huge drop in the last quarter, pretty big unwinding event. It kind of rallied up, had a huge range wick here. You can see this range, pretty massive range. And now all these bars here have been inside bars. Typically when you've got a giant bar and then you see price climb up, pierce through it, and then get rejected down, there is downside potential all the way back down to around the bottom here, which is 1360 area. So right now, this is in a high volatility, kind of high risk pattern on the quarterly chart, and we really still could come down and flush in this pattern. This giant wick followed by this big sell-off is really a level saying that, hey, this is got a lot of work to do, this chart, before it's going to find support. Now let's just take a quick look at the daily chart of Palladium and get a feel for what it is doing. If we just zoom out a little bit, you can see here, it's a pretty gnarly chart. It's kind of worked itself up, had the COVID crash, came all the way back up, poked to some new highs, and it's trading back down here. Looks like it's probably trying to find some support. I typically look for 3 surges to a low like this. Each time it makes a nominal new low, followed by a sharp snapback rally. So we could be very close to seeing this carve out a bottom. But overall, a lot of damage has been done. The trend is down short term. And even on the quarterly chart, it's showing that it's potentially got a year or two of work to do before it can work itself out of that pattern, which is really a 50-50 bet which way Palladium is going to go from there. So hopefully that gives you some insight. To me, gold looks like one of the best setups. Silver, struggling a little bit. I do like platinum more so than silver at this point going forward. But that's your technical take. And I'm Chris Vermeulen from the technicaltraders.com. Take care. Bye-bye.